I thought, and then suddenly
Yeah.
you pop up and the sunshine.
Yeah, and you're like, yeah, we did this. I feel it's important to mark those moments. Otherwise, you just get on with the next damn thing. And
I should say, I'll let you introduce yourselves. I'll just hand it over.
Yeah.
Actually, I'll hand it over to you. Maybe you can just quickly introduce yourselves.
it's currently on.
Just sort of say, really introduce yourselves. Just what your discipline, I think maybe just focus on what your discipline is.
Yeah, I mean, do you want to say anything at all?
Me? No, I'm going to do like 30 seconds and then sit down.
So are you
Just hand it straight back.
Is that green?
I'm colorblind.
Oh, yes. That's green.
Hello everyone and welcome to the Library of Mistakes. Once again, thank you to our drink sponsor, Kennox Asset Management, for keeping us all lubricated this evening. And if you're only watching at home, then unlucky for you. Come next time. Come and join us at the Library of Mistakes. We are a library that is open to the public, so please tell your friends they can come and study here. And we do other things. There's a podcast, which is very well attended virtually. And obviously we do our series of lectures. And you can find the other lectures, the older lectures, all online on our YouTube channel and through our website. Tonight we're here to launch a new book, which is on sale tonight at the back after this. You don't need cash. We have a card reader. And if you'd like to buy copies, hurry up, because there's only a certain number available. So, and it is this book, Invested: How 3 Centuries of Stock Market Advice Reshaped Our Money, Markets and Minds. And it's something that the authors have been working on for some time, and with conjunction with the Library of Mistakes. And we've been very lucky to get some of the exhibits around this room come from an exhibition they did a long time ago now, quite a few years ago. And they came here. We've got some books here, and we've got some little leaflets over there called The History of Financial Advice, which you're free to take with you as well. So that's tonight. I will get out of the way, hand over to the experts, and begin by handing to Helen Paul.
Thank you very much. My name is Helen Paul, and I'm going to be your compere for this evening. But I'll just introduce myself, and then I'll let my colleagues say who they are. I'm an economic historian. I work on the South Sea Bubble, and I work at the University of Southampton. If you could turn to you.
Yeah, hi everyone. I'm Paul Crosthwaite. Somewhat improbably, I teach in the Department of English Literature at the University of Edinburgh. But have developed over the years a very strong and abiding interest in the kind of conjunction between literature, writing, narrative, storytelling, and finance and economics. So that's kind of how I came to this topic.
Yep, and I'm Peter Knight. I teach American Studies at the University of Manchester. And like Paul, I've been working on the intersection of culture and finance for quite a few years. And I also work on conspiracy theories and how they cross over at times.
And hi everyone, my name's James Taylor. I'm a lecturer in history at Lancaster University, and my specialism is more 19th, perhaps a little bit 20th century British history, in particular history of fraud and history of corporate governance.
Well, thank you. And we are missing Professor Nikki Marsh, also from the University of Southampton, because she had to deal with flooding on the train lines, but she would have liked to be in here too. So I'd like to thank my co-authors, Peter, Paul, James and Nikki, but also, of course, Russell, for warmly hosting us and being incredibly generous with his time and turning up to our meetings, giving us his opinions about the work. So what we have managed to produce is partly the way it is thanks to him, and also to our advisory board as well. So what I'm going to do is give you a brief overview before we go and split into each one of us talking about slightly different angles of the book, What it is not is a book that tells you how to make yourself rich through the stock market. And although we use the term financial advice, we really meant the kind of materials that are popular, that target how to make money in the stock market. Are these books useful? Are they not useful? What do they do besides telling you how to make money? So basically, it's part of the economic humanities, an idea that culture, language, representation can give meaning to and take meaning from economic concepts. So it's not simply a very numerical approach to finance. It looks at a broader range of things that shape people's worldview of the financial markets. And therefore, we're looking at stock market advice as a form of writing, looking at its genres, styles, the set of assumptions that it makes. We're not particularly looking at whether it necessarily works or not, although we touch on that a little bit. And we look at where it began and how it changed over time, and the kinds of futures that we might see from this type of writing. What kind of cultural work does it do? If the evidence that most of these books don't actually make you incredibly rich, why does it continue to be popular? That kind of idea. We start off with an investment system in the early years of the financial revolution, the exchange alley, where people had gained a lot of information from conduct books and price lists, print culture, and as the value in the economy moved from land towards the city. The South Sea bubble in particular is a time when this is exciting, you can seemingly make a lot of money, but it's also very dangerous and upends certain hierarchies in society. So I'm particularly interested in how issues of race and class and gender come out in some of the early writings and persist through this genre. And we start with Thomas Mortimer's Every Man His Own Broker, which is the first real attempt to try to create what we now see as a stock market advice manual. It's a compendium of different things in one, very, very risk-averse advice on the one hand, and then a lot of dramatic interludes and imagined scenes in Exchange Alley, particularly critical of certain groups who are the outsiders or the minority groups. It's very anti-Semitic and racist. It's very classist. And Mortimer really believes that women should not be allowed anywhere near the market. In fact, every man should be his own broker, but every gentleman should step in to help his female relations so that they don't have to contaminate themselves in the stock market. Yes, well, yeah. So that issue about who is acceptable in the market, who's the advice for, continues right throughout, but often in a very buried way with the assumption that you're talking to white males in Britain and then the US, and the assumption that you're not talking to other groups. So sometimes there are books specifically aimed at women. Often it assumes that women are just not present, or say African Americans are not present. There are ways of excluding people without being quite so obvious as Mortimer. So if I can start off with turning to one of my colleagues here, and I will ask Paul how crises really made an impact upon the genre, because, of course, over 300 years there are recurrent crises, and yet people still want to buy these books.
Yeah, thanks, Helen. I guess in this long history, the paradigmatic crisis that really kind of shook the financial world to its foundations and the genre of investment advice to its foundations was the great crash of 1929, the Wall Street crash. For decades afterwards, workers on Wall Street talked of the shadow of 1929. They lived in that shadow, they felt that shadow. It was a kind of persistent trauma that hung over the street. And this was felt very strongly by writers of investment advice. It was a particular blow to the technical analysts. I'm sure many people in this room know what this term refers to. Those market analysts who believe that there are patterns in the movements of prices and that the future movements of prices can be predicted by examining the cycles, the movements, the patterns of previous price, of previous market movements. The crash was a real problem for the technical analysts because the market fell through what the technical analysts like to call support points or resistance points. The theory was often the market would reach a certain point and then it would kind of be buoyed up, but it just kept plunging and plunging and plunging. So this became a real problem conceptually for the technical analysis school. One exemplary exponent of the form, Humphrey B. Neal, in his 1931 opus, Tape Reading and Market Tactics, reflected on this and tried to kind of rescue his discipline from the challenges that it now faced. Neal's gambit was to really double down on one of the kind of central tenets, central articles of faith for the technical analysts, which was essentially that markets are driven by mass psychology. That the reason that markets stray from a notion of kind of fundamental value, what a stock is really worth, is that people get either overexcited at the top of the market, and so the price rises above what it would be a kind of an accurate reflection of the inherent value of the stock. And by the same token, people get too worried, too anxious, too panicked, and the stock plunges lower than it really ought to. And his argument was that, well, isn't that exactly what the boom and bust of the 1920s proved? It proved what we were saying to be right as clearly as you could imagine. The fact, he says, that during the past 8 or 10 years, millions of people have bought stocks for the first time must be considered when we are trying to estimate the ebb and flow of stock prices. And he goes on to hazard a forecast. More attention will be paid in the future to an interpretation of human nature as it is affected by economic factors than to the economic factors themselves. So psychology rules. The real facts on the ground, so to speak, are always overtaken by the ebb and flow of the market, driven by these kind of animal passions, animal spirits. So the technical analysts kind of doubled down on their position. And one of the reasons they needed to do that, one of the reasons they felt they kind of needed to stand and defend their ground, was because precisely of the rise to prominence of their kind of great antagonists, the fundamental analysts. Now, fundamental analysis had been around in certain versions since the late 19th century and into the early 20th. But it was really in the wake of the Great Crash in the 1930s that the recognisable discipline, the field of what we now think of as fundamental analysis really emerged. And it did so particularly through the work of two authors, Benjamin Graham and David Dodd. Graham and Dodd. Graham is probably best known for 1949's The Intelligent Investor. Warren Buffett, no less, has called it by far the best book about investing ever written. And it remains this kind of Bible for many. It was 1934 security analysis, though, that developed and popularised the notion of value investing, which was the kind of credo of Graham and Dodd. And security analysis is really very clearly presented as this attempt post-crash to kind of go back to sort of sober, common sense basics. Strip away all of the hype, the excess, the irrational exuberance, as we might now say. What is a stock really worth? How do we work that out? How do we determine the inherent value? Inherent value was their great kind of slogan of a security. They note that from earning power, it's possible to derive a measure of intrinsic value. But they define intrinsic value quite pragmatically. It's not possible necessarily to determine exactly what the intrinsic value of a given security is, but the analyst needs only to establish either that the value is adequate or else that the value is considerably higher or considerably lower than the market price. For such purposes, an indefinite and approximate measure of the intrinsic value may be sufficient. So you don't have to know exactly what the stock is worth, but you can kind of gauge whether it's kind of wildly out of sync with how the market is valuing it, or whether the two are more or less in alignment. Now, this book, this intervention, was very well timed, very fortuitous, serendipitous even, It emerged, as I say, in the early to mid-1930s, and it coincided with the New Deal financial regulatory regime in the United States, which, amongst other things, resulted in an unprecedented mandating of the disclosure of precisely the kind of corporate information that conducting fundamental analysis required. Suddenly, there was reams of information and a new transparency about corporations that hadn't been there before. So you could really do this stuff in a way that you hadn't previously been able to. So in a sense, somewhat paradoxically, the 30s and 40s were actually golden ages for both of these fields of technical and fundamental analysis. But to a certain extent as well, contradictions inherent to these fields really began to come to a head in this period. And there was a lot of tit for tat between the two sides. The fundamental analysts would point out to the technical analysts, as they still do, well, if this pattern really existed, everybody would act on it and it would disappear. So they would point to what they saw as a kind of conceptual or logical flaw in the technical approach. By the same token, the technical analysts would say, well, you might think that you can sniff out a piece of information that shows that a stock is misvalued and trade profitably on the basis of it, but actually the market has got there first. In a kind of proto-efficient market way, the market is always priced accurately, and any information that you found is already priced in. So they pointed to these kind of conceptual contradictions or flaws or paradoxes in one another's fields. And in subsequent decades, under the rubrics of modern portfolio theory, the efficient market hypothesis, academic finance theory would really zero in on these aspects of these two fields and subject them to intense scrutiny. But that wouldn't be the end of the story, because in the work of figures like Burton Malkiel, it would turn out that you might not be able to beat the market, but you could align yourself with its infinite wisdom and gain benefits from it in that way.
Thank you very much. And certainly we're interested as well in why people write these things, what's in it for them, particularly if they are themselves fraudsters. It's an interesting subgroup. So I'm turn to James for a little bit more about that.
Thanks, Helen. Yeah, I guess it dawned on us quite quickly when we were researching this book that more or less everyone who's writing this advice has got a certain interest, a certain economic interest in producing this advice, in marketing this advice, in selling the advice. Because after all, what they're doing is not necessarily simply making money themselves on the stock market, but persuading others that they have the wisdom that they can share that will make you the money on the stock market. So it's selling this idea, it's selling this promise of wealth rather than actually making the money themselves. All of these books of financial advice, manuals, guidebooks, circulars, we look at all these different kinds of printed advice. And they're all commercial propositions. They're all commercial propositions in their own right. So we're looking at this literature, which I think probably a lot of economists looking at this would think, well, why are you reading this marginal literature, this literature which promises so much but isn't really economically significant? But I think there's a really fascinating story to tell when you center that kind of printed advice. Because after all, if you're living in the 19th century, you're interested in the stock market, you've heard of the stock exchange, you've heard of the fortunes that can be made on the stock exchange. If you go to the canons of economic wisdom, if you turn to your Malthus, your Ricardo, your James Mill or John Stuart Mill, they're not going to give you much information on how to actually play the market. But if you look at this parallel literature that is flourishing, really beginning to flourish in the 19th century, you've got people who will promise this. And Helen mentioned earlier Thomas Mortimer. He's the figure we always come back to. We always come back to in this kind of narrative. The first edition of his book, 1761, Every Man His Own Broker, it continues to be published right through into the early 19th century. And he's a great example of this kind of interested advice, where he sells at least 50,000 copies of his book. It's hard to get exact sales figures, but this goes through multiple editions. It's reached its 13th edition by the turn of the century. He sets himself up as a market advisor, so if you've read his book and you want more bespoke advice, then you can turn up in Exchange Alley and actually meet him, and he'll talk you through the processes of buying and selling shares. So it would be a bit anachronistic to refer to him as a kind of celebrity advisor, but we can certainly see the roots of more modern kind of celebrity market specialists in what he's doing. But what's really interesting in the early 19th century, as he eventually dies, he has to die sometime, and his brand fades. His book's still in print for a while, but that kind of mantle of stock market advice passes from the outsiders, from people like Mortimer. He was an outsider, he was not a stockbroker, he didn't have any official standing. The mantle of that kind of advice passes to insiders for a while. So stock exchange brokers, respectable figures, they're all about kind of talking to a relatively small community of investors, of middle class, fairly affluent investors. They're not so much interested in giving advice as such, but just sharing data about the stock market and perhaps explaining some of the technical terms. A lot of the advice literature we look at contains the glossary of all the terms you need to know. What's a console? How do dividends work? This kind of thing. But they're not really giving advice, because as soon as you get into advice, then you have those problems of self-interest. They want to stand above that. They want to make the stock market respectable. So these are the main kind of writers of stock market literature through much of the 19th century. But what we find really interesting when we turn to the later 19th century and the real proliferation of this genre, when we can start seeing it being published extensively and being a much broader base to this literature. It's the outsiders again who take the lead, because the problem with the London Stock Exchange, very illustrious, wealthy as it is, its members are not allowed to advertise, and writing this financial advice literature smacks a bit too much of advertising. So not many of those brokers publish advice. It leaves something of a vacuum for all these newly affluent citizens in the later 19th century who want to make their fortunes on the stock market. They turn to outsiders, to outside stockbrokers. And these are really the main providers of this literature through much of the second half of the 19th century into the 20th century. And they're all self-interested. They're all blatantly self-interested. Many of them are fraudulent. I went into this project having just completed quite a big project on 19th century corporate fraud. I'd had enough of fraud. I wanted to leave fraud to one side and look at good, honest stock market advice literature. That was a little bit naive of me, I quickly realized. Because if you're looking at who's providing literature about the stock market, who's explaining to people how to do it, who's trying to get people into the stock market, it's these often somewhat dodgy outside operators. They're not all dodgy. The outside market, those brokers are operating without any restriction on their activities. Some of them are honest. Some of them are very successful, make an honest business. Operating outside the stock market even gives opportunities to women to operate as stockbrokers, which is a very fascinating sideline to this. So the outside market is very interesting, very diverse. They're certainly not all fraudulent, but many of them are, and this is where the bucket shops come in, the famous bucket shops, where bringing people in, selling a very democratic message that anyone can be a speculator, anyone can make a fortune. The price is tapping out on the ticker. You've got this access to real live price information. We'll give you the systems, the methods, the techniques you need to know to beat the market, that kind of promise of beating the market. Many of these bucket shop operators are fraudulent. Many of them are criminally prosecuted. It's hugely popular. It produces a vast amount of literature. It's what we quickly discovered, that so much of this literature is penned by these clearly self-interested operators. But then it gives you that question of why do they flourish for so long? We're talking several generations here. They don't just boom and then fade away when everyone realizes how self-interested their advice is. There's a whole bunch of interesting reasons why that is. I think the persuasive narratives that they're selling, it's not just get rich quick. If it was as simple as get rich quick, then I think it would be a much less interesting story, and it wouldn't be as pervasive. We wouldn't see it still exercising such an influence as we move into the 20th, 21st centuries. It's also a message of democracy. It's also, going back to Mortimer, every man his own broker. Anyone can do this. We will level the playing field. We will share with you the inside secrets. That democracy of knowledge. We can certainly see that in later iterations with the onset of the internet. all the promises that were made about the internet, leveling the playing field, the democracy of access to information. So that's really prevalent in the 19th century. The idea that outsiders will share the secrets of the temple. That's a very alluring one. The newspaper press, which is really developing at this time, although on one level it's kind of exposing the more fraudulent end of this market, but at the same time is also very self-interested, is also quite corrupted with, is carrying the adverts of all these outside brokers. In many cases, the newspaper editors are working hand in hand with the bucket shop operators. So there's all these opaque kind of networks of interest which are going to be invisible to the ordinary market operator. So there's all these seductive narratives that we see perpetuating this financial advice. There's also the idea of stock market advice. This really struck us quite early on, I think. Stock market advice as entertainment. But not everyone reading this is going to end up investing themselves or speculating in the market. But the armchair speculators, those who are imagining these fantasies of wealth, imagining what it's like to walk down Exchange Alley, what it's like to walk into a bucket shop. So this literature is meant to be very entertaining. It's not like reading Adam Smith or Ricardo or Malthus. It's much more entertaining than that. So there's this seduction of the kind of entertainment, the spectacle of speculation as well. And another device that we see a lot, and again this has relevance to when you move into the 20th, 21st century, the kind of dressing up the advice as scientific, that search for scientific knowledge. This is going back a bit to Paul, who's talked to us about the kind of scientific methods of stock analysis that developed in the early 20th century. Many of these bucket shop operators are pioneering this kind of technique of dressing up their advice, which might be quite unscientific, in scientific garb. To take one really good example of that, we've got a page on this in the book, so we could talk for longer about this. Henry Lowenfeld, if anyone's heard of Henry Lowenfeld, he's really not quite the inventor of portfolio diversification, that would be a bit too strong, but he's certainly the popularizer of it at the turn of the century in Britain. He starts out as a bucket shop operator, reinvents himself as a very respectable stock market analyst, sets up this huge publishing empire around the investment registry, which is advising middle and upper class ladies and gents in London in the Edwardian period. And his big idea is portfolio diversification, dressing up a method of investment with a scientific language. And his ideas are still looked at today by some economic historians, very influential. And he was clearly onto something, and there was something in what he was saying about portfolio diversification, even if in his version of it it's very crude and very basic by today's standards. But alongside this, he was offering his own services that if you wrote into him and his team, they would manage your portfolio for you. They would take a look at your investments, send in a list of all your investments. They would go through the list, tell you which ones to keep, tell you which ones to sell, and would sell you better investments. And this was one or two of you picked up on the flaw in this plan, that they had access to lots and lots of cheap stock, dodgy stock that no one else wanted. They would get you to sell your very reliable but perhaps relatively low yield investments and flood you with all this worthless rubbish, basically, that would clog up your portfolio. You'd end up losing money. Lowenfeld would end up making money. So he's this very fascinating character. A lot of people who talk about his early essays on portfolio diversification don't know the more fraudulent sort of end of his business. So I think just his kind of career illuminates a lot of what we're talking about, the kind of conjunction of interesting, innovative ideas, but also quite opaque layers of self-interest here, which might feed into some of the more recent kind of celebrity advisors.
Thank you very much. Peter, you get to go last. You've got about 10 minutes tops. Mm-hmm. So really, if you could sum up the whole project, this issue about, as James was saying, why buy the advice? Because unfortunately, James has covered so much of why buy this advice. Maybe you'd like to talk about some other aspect that we have missed out.
Yeah. So, really, we started from the question of why do people keep on buying this stuff if it clearly doesn't work? Maybe that was kind of a false assumption to begin with, but the more you read this stuff, the less convincing it is. And so then you're left with the puzzle. Well, why does it keep on being sold? And why do some things remain in print long after they've been proven to be completely economically illiterate or fraudulent, directly fraudulent? And so what we're not doing is assessing the kind of economic rationality of the advice. And in fact, there was an interesting paper by a Yale economist, what's his name? Choi, just about 6 months ago, where he went through all of the kind of recent bestsellers of financial advice and measured them up against current economic theory. And in most cases said, nope, they're wrong. The economists are right, and this popularizing stuff seems to kind of lag behind economic theory. Well, we weren't doing that. What we were doing was asking a question by standing back from all of these books and coming at it very much as historians and kind of literature and culture scholars and trying to wonder, why do people keep on reading this stuff? And as James suggests, part of the answer is it's fantasy football. But there are a kind of number of other things I want to touch on. So obviously there are some perennial themes that come up again and again. Part of it is the fantasy of easy profits and the certainty of a success. That's what they're selling again and again. But at the same time, obviously they're trying to say that this book is new because conditions have changed. And so you get this endless dance between, on the one hand, saying this is timeless wisdom, respect this because it stood the test of time. At the same time, buy this book because it's got something new that no one else has ever done before. And so I think that these books are always trying to kind of paper over that contradiction between perennial timeless wisdom and the need for something that is distinctive and new. So if you look at, for example, a book by Tony Robbins, his 2014 #1 New York Times bestseller, Money, Master of the Game, 600 pages, but it boils down to kind of two fundamental insights. Number one, buy a set of index funds. Number two, do nothing. So the question becomes, well, what's the other 599 pages doing over and above that? So one thing we found is that the genre survives and in fact thrives despite the mounting body of evidence from academic economists that it's all complete and utter rubbish. And the reason for that is partly the fantasy of beating the market. That's what it's selling again and again. And it's a fantasy that is distinctly populist. It's the idea that you, the amateur, the outsider, as James was suggesting, can somehow beat those experts, those insiders. But of course, as Paul mentioned, as the efficient market hypothesis teaches us, if the formula worked, if the tips in this book worked and everyone followed them, then it would, by its very nature, completely undermine it, undermine the strategy. If everyone followed it, then it wouldn't work anymore. And that's one of the things that these books have to try and kind of paper over, to try and kind of hide the fact that if everyone followed it, then it wouldn't work. So the appeal is always to an individual. It's always to you that you've seen something that other people haven't, or you've been wise enough to buy this book that somehow other people aren't, even though the book is trying to say everyone needs to buy this book. So part of the appeal of these books is not so much the specific financial tips and strategies, but the sense of cultivating a particular personality. The advice is always bullish rather than bearish. So, for example, the sports blogger turned day trader Dave Portnoy condenses his wisdom down to, once again, two rules. Rule number one, stocks only go up. I think he was writing in 2020, maybe before things didn't obey that rule. So rule number one, stocks only go up. Rule number two, when in doubt whether to buy or sell, see rule number one. So these books are selling a fantasy of beating the market. Often they rely on contrarian strategies, or at least are appealing to that idea of being contrarian. And so they are often explicitly populist. We see this, for example, in the kind of GameStop saga from a couple of years ago. But this doesn't just begin with the age of Trump and the kind of forms of populism. You see it in the 19th century. So, for example, an advert from a brokerage in London in 1889 exhorted their clients to follow their stock tips and, quote, squeeze the bears. So this is something that, you know, it's an appeal that's being made from generation to generation. And these books often play to the fantasy of heroic, risk-taking individuals, nearly always men. That's the ideal. And often there's an association with sport and excitement. So Burton Malkiel, who Paul mentioned, tells us that telling an investor that there is no hope of beating the averages is like telling a 6-year-old that there is no Santa Claus. It takes the zing out of life. And this is the very man who, in effect, is taking the zing out of investment by saying the ultimate solution is passive investment. But he realizes that the thing that's going to be missing is the zing. But also, often, either implicitly or sometimes quite explicitly, these books are promoting the erotic pleasures of investment. Even Burton Malkiel, who is supposedly, you know, the voice of sober wisdom, saying passive investment is the way forward. In his classic book, A Random Walk Down Wall Street, he actually tells the origins of his original Random Walk Down Wall Street. And he says, back in 1959, during my days in the investment business, I used to spend many a pleasant lunch hour strolling randomly along Wall Street and gazing upon the bevy of young women passing by. And so this is where his famous theory of the random walk down Wall Street comes from. It's ogling the secretaries on Wall Street. So as much as he's giving this kind of sober advice of you can't beat the market, passive funds are the way forward, at the same time he's saying, actually, the thing I really miss is thinking of stock market investments like flirtation. So the main conclusion I think we come to in the book is that these books work like diet books and recipe books. Yes, they're giving practical advice, and yes, in theory, you could follow them, but that's not why we read diet books and recipe books for the main part. We read them because they give us a kind of a fantasy. They in effect work as self-help, and these popular investment advice books really, when all said and done, are a form of glorified self-help. They reframe stock market investment not as a possibility, but even as a responsibility. But more recently, it's actually almost the other way round. Investment advice comes to reshape the whole paradigm of self-help itself by advocating what we would call a financialization of the self. So in recent self-help writing, the readers urged to cultivate a stock market investment mentality, not just in the realm of the stock market, but in your life as a whole, to become an entrepreneur of the self, to think of the family as as a mini corporation. But the irony of all of this recent advice of saying turn your whole life into a kind of a stock market practice. The irony is that the one place that you should no longer be this entrepreneurial, risk-taking, heroic individual is in the stock market. Because ultimately, nearly all of the kind of recent advice says, actually, buy index funds and hold them. So this is the kind of peculiar situation where writers like Suze Orman and Dave Ramsey and Jim Cramer and Ray Dalio, all of these kind of gurus of contemporary financial advice, what we think they're doing is, in effect, offering individual solutions to what we see as structural economic problems. They hold out the dream that financial self-discipline, that kind of stop drinking your lattes, stop ordering avocado toast, that kind of financial advice of self-discipline is going to somehow magically mean that you can bypass the problems of stagnating wages, of increasing inequality, of economic shocks, and the dismantling of the welfare state. That's the false promise that these books are selling, that we think at the end of the day. So,
thank you very much. Well, we have two rules. One is rule number 1, stick to time, and rule number 2 is see rule number 1. So, thank you very much.
So we do have time for some questions. That's why we stop. And man, that was quick.
That was wonderful. I worked for most of my career at a tip sheet called the Financial Times, which was founded in 1888, if I'm not wrong. So my question goes back and then forward, which is, the back is Mortimer and all his type, the sort of fraudster tip sheet types, and the flourishing of this literature came to a kind of probably a little bit of a halt, if I'm not wrong, when the regulators, you mentioned the regulatory intervention of the New Deal in America, the founding of the Securities and Exchange Commission. But then listening, Peter, to you, it sounds like we're back in the Wild West days of this kind of... So my question is, where on the continuum of all of that are we now with the Jim Cramers? Is Jim Cramer the modern Mortimer?
Just to let you know, this is being live streamed and recorded, and we are unlimited liability.
Allegedly.
I think we have to draw the distinction between kind of self-interest and fraudulent. So I don't think many of the people writing this advice have a clear self-interest. Sometimes that's hidden, sometimes it's out in the open. Having it out in the open doesn't necessarily invalidate their credentials. Sometimes there's a bit of a kind of double play going on there. But I think probably, yeah, without sailing into the territories of libel, I think what we're seeing when we look at the modern day financial advisor celebrities is a kind of just repetition of a lot of the ideas, a lot of the tropes that we've seen going over the previous 250 years or so. So there's, we expected perhaps when we turned our attention to the modern age and looking at the impact of the internet on financial advice, even looking at the impact of COVID on financial advice, which we do in our epilogue at the very end of the book, we expect to see changes, but we see these kinds of cycles, these repetitions of ideas. And so the kind of self-interestedness of someone like Cramer or Suze Orman, which is often exposed, doesn't destroy the brand, doesn't invalidate it, doesn't stop people kind of buying into it. And that's just the same with Mortimer. When his interests were exposed, it's just the same with these bucket shop operators.
Yes,
so
exactly this continuum that you're thinking about. Are they fraudulent today, or as they were in yesteryear? It's the same tropes.
Yeah, and I think there's this interesting sort of distinction to be made. They're offering financial knowledge, but at the same time, kind of there's a knowingness about it. So it's interesting to think about the relationship between knowledge, which is ostensibly being sold, but the knowingness, the kind of audience being complicit in this? Because after all, who better to advise you than someone who knows all the dodges and tricks and ruses, who's been there, who's maybe profited themselves from some of these tricks and ruses? That's the kind of person you want on your side, not some innocent who's never experienced any of that and knows nothing of it. So you see this kind of trope recurring time and time again, that it's even, you can build an argument in kind of that's how the privatized utilities were sold in the 1980s with the Tell Sid advertising campaign. That's all about selling a particular idea about you need to be on the inside to make money on the stock market. So the narrative in these ads is this secret tip being whispered around a village community. It's a secret being passed on. It's kind of this dodgy knowledge that these people have, that the nudge, I'll just write you the number you need on this scrap of paper, and with that, you can make money. So it's a kind of, the stock market's always had this kind of veneer of not quite full respectability, but it's that grey area between respectability and not quite respectability. That's where the money's to be made. So I think we see that time and time again.
Just one thing I would add in there, one major difference is that in 1900, only 1% of people were invested in the stock market. In 100 years later, it's 50%. And so the importance of popular financial advice suddenly becomes a lot more worrying in that sense, given that we're all invested in the market now. Yes, it was more in the realm of fantasy football for young clerks going to bucket shops in the late 19th century. But now, if our kind of economic security for all of us is reliant on the stock market, suddenly if the place where people get their advice are these kinds of books, then that is concerning.
Most people surely go through buying things.
Yes, yeah.
Not getting their advice from books. These books are not widely read.
They sell in the millions.
Already selling millions in America, but
Yeah.
around the world.
Okay, yeah. I was just interested if you noticed any difference between, say, the US and the UK, because I might be wrong, but I get the impression that in America, talking about the stock market is a much more popular activity, and it's much more niche over here. I just wondered if you noticed any difference in that, or if I'm just making that up.
Yeah, I mean, this is a kind of pivot that our book tries elegantly to perform, and I'm not sure how elegant it does, from starting squarely focusing on the City of London to, by its end, squarely focusing on Wall Street. So that we see very much the kind of centre of gravity of the genre of investment advice migrating across the Atlantic to the States over the course of the 20th century. There are a whole range of reasons for that. I mean, to a certain extent, it comes down to just the kind of information that was available relatively between the City of London and Wall Street. For example, if you wanted to do technical analysis, you just wouldn't have the level of detailed data on the stock ticker in London that you would have in New York or in points that were connected telegraphically to New York. So there were certain things about the transmission, the dissemination of information in the States that just provided kind of fodder for the kind of increasingly recondite forms of analysis that were being developed there. So it certainly it flourishes and becomes much more complex and takes on all kinds of different systematic iterations in the States, whereas in the UK, the advice tends to remain fairly kind of meat and potatoes for a much longer period, I think.
Listening to this, I almost was hearing about today's cryptocurrencies. For your second edition, how many words would you have to change in the book to describe cryptocurrency enthusiasm today?
Yeah, so we do begin and end the book with things about GameStop and other meme stocks, NFTs, and yes, we kind of nodded towards cryptocurrencies. And it's very much in that kind of, obviously, it's a bubble like many other bubbles we've seen in different moments. But what was interesting about cryptocurrencies for us is the way it kind of has that populist appeal of it's deliberately trying to kind of oppose the financial mainstream and oppose the hedge funds. There is something kind of resurgent or kind of Trumpist about a lot of the rhetoric, and that's often kind of weird because it combines, you know, people who are coming from a kind of an anarchist, left-leaning side in the kind of earlier forms of cryptocurrency with the more kind of meme stock, you know, fuck the hedgies, as they phrase it. And so, you know, that kind of weird combination that I think we're seeing kind of politically in quite a lot of countries with the rise of different forms of populism. So yes, that's why we find cryptocurrencies interesting.
Does your book say much about academic books, or is it populist books that you're considering? And I'm really talking about emerging talent. Can you repeat your question?
Yeah, is our book concerned with academic works of finance or popular works? Resolutely popular works. Obviously, in some places there's some crossover, but we're interested in the kind of books that are being, not just books, but kind of newspaper columns and tip sheets that are being marketed to the ordinary investor, whoever that is conceived to be. But so it's precisely this particular genre that we've identified as being quite separate to other kinds of either kind of professional advice or kind of you know, kind of more academic works. So it's very much the popular end of the spectrum we're interested in.
Nobody's going to read about modern portfolio theory or the efficient markets hypothesis, unless you're in the academic world.
Thank you. This was fabulous, actually. Thank you very much. I was wondering, I was very struck by what I think Peter said, that most of these books are bullish, or at worst, hide under the bed passive investment. But I'm also wondering why the success of, again, popular books that are post-mortems of financial disasters, why they don't translate to books that give advice for bearish approaches. I'm thinking, well, the GameStop and kind of the crypto crowd that you say that a lot of it is left-leaning, anarchist, let's shake the world. Why don't they shake the world by shorting everything? And then I was thinking of a very, very popular book, which is a postmortem of a disaster, which is, of course, The Big Short, which describes how people do a lot of the things that you described. They are the Lone Rangers going against the sheep. They are, one of the case studies is little people who are, you know, they're not big hedge fund managers. You know, everybody sneers at them, they're completely ignorant, and then yet they walk away with hundreds of millions or whatever it is. And I'm just wondering, is there any particular reason if, and I take that it's completely true, that this doesn't translate to books that give people the tip to go against the crowd by shorting, by taking advantage from the fact that actually all the other books haven't worked because everybody's bullish. But actually the truth is, and hear me, short everything, that's the way it is. Why is that? Is that seem to be, I don't know, unseemly to want to short the market, or would you hazard any reason?
I mean, certainly there are appeals to a bearish sensibility, as I think Russell would probably confirm. But, I mean, I think part of it, in very basic terms, is that short selling is a relatively technical market maneuver, which isn't necessarily going to be as accessible or practically viable for your average person in the street trying to dabble in stock market investment. So part of it might just be the relative technicality of short selling as a technique. Beyond that, I think it does, though, relate again to this kind of idea of a kind of a fantasy, vicarious dimension to this kind of material. The sort of the classic fantasy of the stock market is of winning and of being kind of buoyed along by the exuberance, the excitement, the exhilaration of the rising market, of the boom. And I think that mythology, that iconography, is so powerful, has such kind of ideological hold, that certainly, for a kind of contrarian mindset, the idea of occupying the bear position could be attractive. But the idea of the bullish mood is just, I think, so pervasive and so powerful that it's perhaps unsurprising that it's that which tends to be appealed to in this kind of writing.
It's almost impossible for the average private investor.
Microphone if you're going to answer all these questions, because otherwise it won't come through on the...
It's almost impossible.
Microphone.
Hello. We got people queuing up.
First of all, can I thank you for confirming that I've saved quite a lot of money by not buying some of the books you mentioned, your own accepted. And secondly, if I could compress the timescale of what you're talking about, at the weekend I'll no doubt buy a newspaper which will, on the back pages, have quite a lot of financial advice, financial analysis and advice. How do you go about rating the value of the advice that's given in these things, given that they've got to write something different every week?
With several journalists in the room, I think we might need to be more diplomatic. More diplomatic than I'm going to be.
Sorry, I have to wait. Thank you very much. Yeah, I mean, certainly it depends what they're saying, doesn't it? Because if it's some sort of top tip, if it's in the papers, it's already been gone through the market system. I mean, that's stock picking via something that takes time to produce. Clearly, the markets have absorbed that signal in the price anyway. Other things tend to be personal finance of a more, things like tax shields or how to avoid, those sorts of things, how to avoid inheritance tax or how to find some loophole. Quite a lot of that is personal finance rather than the stock picking advice that the books go in for, which seem to be about some kind of weird combination of don't follow the crowd, follow your own gut instinct, and you will win in some obscure way. I mean, it's almost like hocus pocus. But yes, again, I know we have some financial journalists, so maybe they can tell us what they write about and how good it is.
We have time for. Is there one more question? Is there? We better go to the. So I think there's a gentleman at the back who's been waiting for quite a long time. So.
I was just wondering if the volume of these books anticipates peaks in the market.
Well, I mean, there were certainly an enormous number of them in the latter part of the 1920s, for example. But then there were a great deal of them in the immediate aftermath of the Great Crash as well. So it wouldn't necessarily, I think, I don't think either of those things is coincidental, but also at the same time it suggests that there's an appetite for this material in a boom period, but also equally for different reasons in a kind of bust period as well, which I think is quite striking.
Yeah, we began the project by compiling a vast database of all of the things that have been published so we could kind of track. And we did have kind of two fantasies. One would be an investment strategy based on that idea of can the kind of peaks and troughs of financial advice predict the market? And then the other strategy, well, the other thing that we wanted to do but never really quite had the money or the resources was to try every single book and invest money according to the book and just then see, which one worked. We didn't get around to that. But maybe if someone gave us enough money, we would be willing to give it a go.
Thank you, everyone. I write financial advice, so this could be a career-ending evening for me. Thank you for that. It's interesting, we have in here a book by Burton Malkiel. It's a new part of the collection, and he wrote a book in 1980 about how to beat inflation. And in the middle of that book, he says, and the most important thing you can do with your money is give it to John Templeton, which is not really so much aligned with a random walk down Wall Street. So this has been a tremendous project. I've been delighted to be involved because we're seeing people from different disciplines looking into economic/finance investment, and you've come on with a completely new and different perspective. I think it's wonderful. Thank you for that. Thank you for the launch. The book is now for sale. The queue will form an orderly queue at the back of the room. Alcohol is also available if you need some of that to get your money in your pocket. Thank you, everybody, for coming along, and please join me in thanking our authors this evening.
Yes.